We think there are some significant improvements that can be made to this. And our advice to Parliament is that the agreement be sent back for additional work to be done on it before Parliament ratifies it. And we will be explaining in a few minutes what are major concerns. First of all, as I've mentioned, lithium is yet to become a very important mineral compared to some of the other minerals, but it's expected to become very important. Ghana currently, from the countries that apparently are going to be producing or already started producing lithium, Ghana, from the data that we have, appears to be at the bottom rank at this point. But that doesn't change the fact that we are around number 6 or so, or number 5 on the continent. So this is our first foray. We must get it right, given the fact that we are positioning the pole position to be important. The minister, makes claims that are just simply not true, and with all due respect. He makes claims that this is the best deal ever, and he suggests that the fiscal terms are the most generous. And that is debatable in the sense that if you think about the dynamics that are confronting us, the fiscal terms that have been presented in the agreement that we are all aware of. Yes, the 10% seems high because in recent times we've been signing agreements that some argue have shortchanged us, and the 13% free carry interest is interesting. But the truth of the matter is that you take the whole historic span of our mining industry in this country, those terms are not that generous, because we can say that in the 70s, Ghana automatically had a 55% participation rate. You couldn't do mining in Ghana unless the state owned 55%. So are we comparing our current fiscal yield on lithium to that era, or we are having an arbitrary period of, say, from 1990 onwards? So what are we doing? So in short, there have been periods in our country when we had way more. Whether or not that was a good thing, it's another debate, because the argument was that by the end of the 1980s, we declined from 33 gold mines to about 4 gold mines, because some argued that the state was too dominant and private investment was not coming in. So private technology, private management capacity, etc., had been shut out. That is a separate argument. But to argue that this is the best in terms of the generosity of the terms is just not true, because we have a history in this country where in the 70s, the Champagne government said 55% of all minerals belong to the state. How is your 13%, or even if you increase it to 19%, or even if you do go further to 29%, as the minister is saying might be the case, how does that compare? We also obviously have had variable royalty structures in the past, as some countries do. Some countries in the region and in the world don't have a fixed royalty arrangement, like we've decided to go for this lithium, in this lithium case. If you remember, as far back as 1987, when we decided to bring the new mining code and to strip away the excessive state dominance in our mining regime, one of the things we did was to pass a royalties law, and that royalties law established variation in the royalty rate. What it means is that how much we get from the outset. So basically, a royalty is something where, regardless of whether the company who is doing the mining makes profit or not, they pay you they pay you an amount. And that royalty, we decided in those days that the smartest thing to do was to look at the operating margin of the company, how much the company is making in profit, and then peg it to that. So when the price of the mineral goes up dramatically on the world market, the operating margin would automatically improve, all things considered, all things being equal. And then we can adjust our royalty rate. So if you look at that adjustment model, there were times when we could get as much as 25% royalty on paper. If you look at WB, for instance, which we signed in '88, and which I think over time Ashanti Gold took over. I think it's now part of the Duprem complex. That deal, from a computational point of view, could get you a 25% royalty because of the variable margin structure. So where did the minister get the idea that 10% is the highest we've ever got? I don't get where that comes from, because we had a period in time when we tied that to the profitability of operation, and based on that, there were periods where, after a particular threshold was hit, we got a certain percentage of every extra margin every extra marginal increase that they got. So that's just simply not true. The truth of the matter, as I've explained, is that even when it comes to what was in legislation, you will see that when the operating ratio hit 70%, in the policy that was signed by Mr. Kwame Pepra in 1987, our royalty rate will hit 12%. And that's even forgetting about operating marginal analysis. It's just a basic minimum arrangement. So in those instances, that royalty was higher than the 10%. And this is something that everybody knows. Anybody who pays attention to mind this country knows. So why would somebody advise the minister? Now, I don't expect that the minister will have time to check all of these things. But senior advisors, including the head of the Minerals Commission, who was so aggressive on the civil society movement because he claims IE had got some number wrong and was all over us. How on earth did he advise the minister that 10% was the highest we've got when we've had fiscal regimes in this country that allows a minimum threshold of 12%, where the operating ratio is above 70%. And if you use the full variable margin analysis that was in that regime, could take you to a royalty of over 20%. So that is as simple as it gets. It's just not true. The other point is that now we give a lot of discretion to the minister. So the minister is able to negotiate these terms, which is why we are also arguing that Parliament exercise extreme scrutiny. Because what we have now is not like we had in the past, where these matters were deferred to legislation, but specific legislation. So in the contracts that we've signed in the past, before our current approach, when we decided to introduce the new mining code in 1987, that agreement required that the royalty rate be deferred to the specific legislation, which would have gone to the People's Parliament if it's a democracy. So in those instances, the royalty is not something that the minister just gets up and put in. And now that we have a situation where the minister just decides that it's going to be 10% or 3% or whatever, we think that it makes sense for Parliament not simply to rubber stamp it, but to take another look and say, look, can we go back to a variable margin structure? What is the pros and cons of that? Is it an issue of uncertainty? Would that affect the share price of our partners, which is the private company? What would be the problem if we say, if you make more money, you also want to make more? The other thing that we have to bear in mind is that the minister does some comparative analysis, which is very helpful by trying to compare it to other countries. And I like that part very much because I think comparative analysis is always a very good thing to do. But I think in some instances, there was a lot of selective analysis, which I don't like. I don't like that because I think when it comes to government officials, their attitude, especially the civil servants who are advising the minister, the attitude to be absolutely objective, not an attempt to propagandize on behalf of the government. It's not the role of the CEO of the Minerals Commission to make the government look good. The role of the CEO of the Minerals Commission is to make sure that the public is getting the best information as possible and is doing his job purely in the national interest. So when you say, for instance, that we are doing better than this, we are doing better than this country, but you don't add the other countries and some of the other things they do, which we are not doing, then you're not giving an objective analysis. So to give you an example, we all know that Zimbabwe and Namibia have introduced policies to ban the export of spodumene concentrate, or what most people call raw lithium. And they are requiring that you do downstream processing to improve the value. We have not yet done that. And I'll show that in the agreement, we've not really imposed that condition. Some will say that is more nationalistic. In Mali, for instance, they've adjusted their policy that allows them to get 20% additional participation on top of the 10% free participation. So they get 10% for free in the equity of the company in their country, and then they get an additional 20%. In our case, we are hoping in further negotiations, because that's not what is in agreement, that we'll get 20%. What is in agreement that is assured is the 10%, the 13%. So in that sense, the Malian regime is more beneficial, but we don't really talk about that. We don't talk about the fact that in Zimbabwe, they have a state lithium company, and they have arrangements to have state participation in actual mining. So they have a joint venture between Zimbabwe Lithium and Zimbabwe Mining Development Corporation, even before they had the expansion that they've seen in their reserves. So my concern there is not that compared to others, we are not doing well. My concern there is that there are others who have done things where the country has benefited more if we are using purely nationalistic terms, like how much in total do you get. But we have to be careful about that whole analysis because, what the country gets and what the investor gets is a dance. You have to do well by the investor, you have to do well by yourself. And it's very difficult to use these very blanket comparisons to attempt to prove that Ghana has done better than all the other countries, because all the countries have done different things. Namibia, for instance, a lot of people talk about the fact that they don't have free carried interest. The government doesn't automatically get get a share in the entity that is doing the mining locally. But Namibia also has a higher tax rate than we do. Namibia also has a stronger joint venture, a tendency to promote joint ventures with Namibian companies. And the Lithium that is being mined in Namibia is a joint venture between a local company and a Chinese company. So there are these complexities that I think was not well served when you look at the way that the comparisons were made. Anyway, one of the more concrete, and here I'm going to now talk about, rather than my analysis of what the minister said, the specific things that we think should be improved. In the agreement, we tie our royalties to the sale of the minerals. Now, the challenge there is that the sale of the minerals then automatically means that the sale arrangements that the company makes dictate the pricing. And we think that there is room to look at whether we can start to explore a benchmark pricing index. Essentially, if you think of if it was gold, where it's a very developed market, so there's a lot of the volatility is not as crazy. There's the London Metal Exchange and other benchmark which gives you pricing for sports and future. And it's easier in the gold agreement, for instance, to say that when you sell your gold, we don't care how much you sold it for. Our royalty will be pegged to the pricing benchmark for LME. And why is that important? It's important because it stops you then from having agreements with people to do offtake that may be lower than we could get in the open market. Because right now, for instance, in our situation, 50% of the lithium, the spodumene concentrate, 50% of it is automatically assigned to a company called Piedmont or Piedmont. And this company will get 50% at a fixed price or a pre-negotiated price, independent of our deal with the company. Now, if for instance, because of the fact that this company is also participating in the entity and has been the one that has funded the early exploration and all of that, it's not an arm's length pricing arrangement, then the challenge that you get is that you as the royalty taker, you're not benefiting from the best pricing. You see what I mean? So it might make sense to try and find some kind of benchmark pricing. It's not going to be very easy for lithium because of the way the prices are moving. But if we are smart, we might be able to develop a benchmark pricing index which goes into the agreement so that if they do offtake agreements with other people, that may be lower the prices. It doesn't affect our royalty because our royalty is benchmark fixed. This some experts may look at this in great detail and say we don't agree, but I think that we have to take into account the fact that because of the nature of the market, it's not a very high volume market. There are a lot of potentially non-arm's length pricing arrangements in the offtake mechanisms that may not benefit us because they may benefit on the other side. Let's say Piedmont decides to invest in another project of theirs on very good terms, and therefore they give Piedmont very good pricing, and then that affects our royalty take. Given the uncertainties, our strongest argument is that the government needs to approach this from a real options point of view. What that simply means is that instead of this very simple agreement that they've done, in some cases there's a benefit to simplicity, but in this case we don't think so. We think there has to be more options in the agreement in some of the respects. We've talked already about royalty. When the operating margin changes, we think the royalty should be variable. We think even in the case of equity, the way that they should exercise the equity is not the way they've done it now, which is they've done it in a two-pronged manner. For the government, it's a fixed kind of thing, and we say in the future we may negotiate for more. For MIF, which is the Sovereign Wealth Fund, they've allowed them to use warrants, which is a kind of option. So what it means is that they have the right but not the obligation to buy more if the price improves. But there are other options that we can use, and why not use it for the state too? Because MIF, given the fact that they can easily exit their position, given the fact that they are a sovereign wealth fund, as opposed to the state, where we have a lot more, the regimen is much more stricter. We are not too happy that the state is not using options, not using some of the warrants. So not just warrants to exercise when the strike price is at a certain level. We want warrants that do other things as well. And we think that the agreement is too simplistic, given the uncertainties in lithium. If you're doing gold, we wouldn't have a problem. But lithium, a lot of crazy things are going on. For one thing, there is a lot of aggressive push. There's a massive and aggressive push to look for alternatives to lithium-based batteries. Laboratories all over the world, some of them funded to the tune of billions of dollars, are experimenting with all manner of battery technologies. In a time may come when lithium-ion batteries are not the big deal in electric vehicles possible. We don't know that. There's a recycling boom where after you use the electric battery, remember that the batteries for NMC, for instance, just 4 years. After 4 years, the charging ratio drops to as low as 20%, and people just simply change it. So when you throw away the battery, nowadays people are recycling the lithium, and that boom is really increasing. A time may come when we are getting more lithium from the discarded batteries than we are mining afresh. And we don't know yet. All of those things, plus, of course, the thing that everybody's talking about, the massive crash in prices. Prices have dropped from a high of about $81,000 a ton for lithium carbonate and hydroxide to something like $16,500 this month. So that's a massive drop in value. So we don't really know what is happening with this lithium thing. That therefore required that we're very careful in the way we structure the agreement to take into account the uncertainty. The other point is also in respect to the same uncertainty is that we are not, this is not gold where we are, the company that we are dealing with is some big established global company with a long track record. This is a very junior miner. In fact, so junior that when they were doing their prospectus in August 2022, they actually boldly said that they had all their mining licenses and they have everything and they are ready to do production. In 2022, when they didn't have a mining license, they didn't have a mining lease, to talk less of one ratified by Parliament. But they were already saying their prospectus and they were raising just $13.2 million. A company that has to tell such obvious untruths, because everybody could have checked in their prospectus in order to raise $13.2 million. It's not a very strong company. Its total market cap, even at that time when it did the raise, was about $342 million. Newmont is about almost a $50 billion company. So this is a very small company. Small companies in early stages of their formation, recently their biggest shareholder tried to acquire the whole company. They didn't agree. That's assured. It's a lot of things can happen. And for all those reasons, and the fact that it's also a very complex structure in the way that is set up in Ghana, it has, these multiple subsidiaries and multiple contracts. Remember that part of the same company of its subsidiary has been operating as a time for a long time in Ghana, hustling in the gold trade. It's not a very strong company, is what I'm trying to say. So you have to be careful in the way you structure your agreement to take that into account. And now we take on MEF, and I'm happy that the CEO is here and can answer to this. But there are a lot of self-congratulatory claims that they make, which are a bit problematic for us. For instance, they make the argument that they've already started to make significant capital gains appreciation on the investment they've promised to make. And it's not clear yet whether they've already signed the documents and therefore they own the 6% contributing interest in Awaya and the 3% in the holding company. But they're not saying that, because at some point in time, the price moved from 26 cents to 34 cents, they've already made money. But that's not how you do these analysis. These are you have to take into account the price over a longer period of time to see whether or not these are trends that you can bank on. Because already that share price has dropped to 27 cents. So the 26 to 34 is no longer even valid. Already the price has dropped. And as the price of the raw material keeps dropping, the share price of Atlantic Lithium will also keep dropping at some point. So it's not clear why they do that. Already this is a company that has lost almost half of its market value since it was established. It's moved from about $342 million to about $168 million. So if you're investing in it, you don't become so self-congratulatory. I'm not saying that there's a problem with the investment. I'm just saying that it's too early to be prematurely celebrating. It could well be that it's a great coup because of what we are all aware of about the transition. And so lithium is going to be big. If lithium is big, Atlantic Lithium will be big. But my argument is that we have not seen that yet. To already say you're already seeing massive appreciation, I think means just propagandist. And for a sovereign wealth fund, you should be extremely conservative. And we have the same with anti-dilution. You don't say anything about the anti-dilution. But the dilution issues in a very early stage company could be said that your 3% could be wiped off if they raise more money, unless you have anti-dilution. And you don't say anything about that. So we have very great difficulty understanding the value of the investments you've made. And we think it's too early stage anyway. Secondly, there's the valuation that has been made about the project. Remember that there is a holding company and it owns a certain share in what's going to be produced. Half of it has already been pre-sold. So for the value of the project, there is a certain valuation that you try and give to the project itself as opposed to the company. And we've seen three different numbers by MEF. In the statement they released a couple of weeks ago, they said the Awaya project is $1.4 billion. In their recent one, they said $691 million. That's the one that they've just circulated to everybody in Ghana. And then we look at Piedmont's investments, because Piedmont is the company that has been funding this project, and they put in early money in order for them to get 50% of the spodumene concentrate when they want to exercise that right. And we look at how much they've invested at and how much they've gained. And that gives you an implied valuation of about $360 million. So we have three numbers, all of them. The last one seems the most plausible. The $360 million seems the most plausible. The ones that MEF have given us, the $691 million, the $1.1 billion, need further explanation. I think if Parliament scrutinizes this very carefully, those discussions will be made. The other issue we have is also that they have all of these provisions which they've praised a lot, value addition and things like that. But actually, there are no timelines to them. So it's not clear whether, when you're after 12 months of this, of getting the license, you are required to serve the Community Development Agency. After this period of time, you're supposed to do this or that. Most of it has been left in very vague language in the agreement. The provisions for refinement, which is the biggest thing that they bank on, that we are doing refining, we hope to do refining in Ghana, it's actually extremely loose. So it says essentially that they would do a study, and the study would determine if they can do more refinements beyond the spodumene concentration to lithium carbonate or lithium hydroxide. And then if the study doesn't say that, then they don't do it. But then they have to be willing to give the concentrate to some other investor who then comes in and does the chemical plant. That is not the same thing as saying that they would definitely do refinement in Ghana. On top of that, it's not clear what refinement you are talking about. Is it that, so if the company, for instance, moved from 5.5% spodumene concentration to 6% spodumene concentration, because remember that in what they are going to be processing now, half of it is 5.5%, the other half is 6%. If they decide to shift the other half from 5.5% to 6%, without qualify as refinement under this provision, no lawyer who reads this can tell you that for sure it doesn't. Or what if they decide to do intermediaries? So move from, let's say, lithium oxide, the raw lithium oxide to some sulfate or chloride before they do carbonate and hydroxide. Would that qualify? We think that whole thing should be drafted with a proper schedule, which gives you some specification for what will be considered refinement in this area. Last set of points. We also think that the geopolitics in this is very interesting. There's a huge competition between China and the US. And the way this has been framed internationally is that this is the first time the US has won over China. And so Ghana has this, leverage that we can apply. And I think we should do better with that. And that comes to the issue of our strategic complements. Lithium alone doesn't really get you into the battery space, which is where we have to get you if we want to really transform our economy with lithium. The battery space requires other minerals, and if you look at the world, there's this very fascinating game theory going on about how the different minerals combine with each other to create strategic opportunity. We think that our opportunity here is potentially in lithium iron phosphate, and because we have iron here, we have lithium here. Lithium iron phosphate batteries use less lithium, and also now, based on the latest studies, they are outperforming NMC, the nickel cobalt based batteries. And lastly, we have Togo just next door, and we have AFTA. We can do some kind of integrated mechanism, ensure that we're producing lithium iron phosphate batteries together with Togo, and that would be very exciting. And we look forward to seeing that. Last point before I end, that the green minerals policy was poorly done because consultations was very, very, very bad. And nobody in civil society, in the segment of civil society that I'm aware of, that's highly involved in these kind of matters, was invited. We don't really understand whether they paid particular attention to the things that we have been saying over the last couple of years in Imani, in ASEP, etc. And we think that because of that also, we don't have a green minerals law. And if we had a green minerals law, some of the delegation of action that moves from the agreement that we've signed to general law would have gone to a specific law. So that a lot of the time you read the agreement, they say, oh, for this you must apply Ghana's law. For this you must apply Ghana's law. But that law is very general. And we accept that for green minerals, it's a different ball game. So if we accept that for green minerals, a different ball game, then why don't we have a specific green mining law? And then when you do these referrals from the agreement to say, oh, for these environmental obligations, refer to the law, or for this, then refer to the law, then it will be referring to a specific green mining law and not the general law that we have, which we already accept is not very suitable for the transition mineral space, which lithium is part of.